In the end, we were left with a listing 61 companies, okay? 61 new listings with actual earnings, reasonable valuations, and non-horrible balance sheets. That's right, 1/10 of what we started with may actually be any good, 1/10. So let me highlight the ones that I think are let's say, notable. First is Perella Weinberg Partners, which is a boutique investment bank that now trades at 8 times this year's earnings estimates. This is a rare SPAC stock that pays a dividend, supports a 2.9% yield. Second, Dole, the fruit and vegetable company. Now, their most recent quarter was not so hot, but a packaged food play feels like it kind of fit in the current environment, especially when Dole sells for 8 times earnings with a 2.5% yield, although I've never liked it historically. Well, it's different forms. Third, Playtika and Nexters are both mobile game developers. We mentioned the former last night, and with Take-Two paying up to acquire Zynga, I'm feeling confident about this subgroup. Those seems interesting to me. Fourth is Traeger. Now, I've been dead wrong on these grill stocks, and these guys have some supply chain issues. But with the stock in the single digits trading at 17 times earnings, it could be a keeper. I'm more sanguine about number 5, though, Solo Brands, the outdoor products company with a stock that sells at 10 times earnings. I like that. 6 is Holley, makes aftermarket auto parts for high-performance vehicles. This is one of the rare SPAC stocks that's above $10, but it's not exactly expensive, selling for 14 times earnings, and it's got steady growth. Holley's a real business. Unbelievable. A SPAC with a real business. 7th, we've got a pair of gym IPOs that I am shocked are doing well. F45 Training and Exponential Fitness. Well, F45 stock has struggled. Exponential Fitness has actually had a nice run. I think they both work once we get over Omicron. 8th, Sun Country Airlines. Very interesting. It's a smaller, feisty leisure company, stock that now trades at 16 times earnings, down substantially from its high, but, travel. 9th, there's Open Lending. That's a technology company that helps businesses make auto loans. FinTech is in the doghouse here, but as the auto industry recovers from its supply chain woes, maybe it makes a comeback. It's 18 times earnings, probably too expensive. Finally, I like Endeavor. That's the parent company of WME, the talent agency that represents yours truly, along with IMG, the sports media and fashion company, and UFC, the mixed martial art league. What makes me like it? Right now, the streaming services are all at war with each other over talent, and Endeavor controls the talent. Plus, unlike most of these stocks, this is actually up from its IPO price. Hey, by the way, another one's up from its IPO price, but it was too expensive as Dutch Bros. I just couldn't include it, but I think it's got great momentum. So anyway, you're looking at, this is it. Here's the bottom line. This is it. Out of the 600 plus, I don't know, this market hates new listings, and it despises the SPACs, and it's all for good reason, because they're junk. But eventually, this indiscriminate selling will create some buying opportunities. And when that happens, you should be aware that the market has fallen far enough that there's actually a few companies that might, let's just say, be, I don't know, interesting.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.